Welcome to Module 2, Establishing Foundational Financial Systems. Today, we are focusing on Lesson 2.5, Setting up Accounts Payable and Establishing Vendor Credit Applications. A hotel's financial ecosystem relies on two primary pillars: generating revenue, the money coming in, and the expenditure cycle, the money going out. Operations teams often pour their focus entirely into driving that revenue, treating the outflow of cash as a secondary, almost administrative chore. But managing that outgoing capital requires its own formalized governance, handled specifically by the Accounts Payable, or AP, system, housed directly within the general ledger. Junior managers mistake AP for a simple clerical mechanism, a desk where bills are stamped and paid. In reality, it is a highly structured, preemptive internal control framework, explicitly designed to track mounting liabilities and protect the balance sheet. Without this, hotels process duplicate payments, severely strain vendor relationships, and report an inaccurate financial reality. A secure accounts payable workflow actually begins long before an invoice is received or a delivery truck arrives at the loading dock. The first line of defense is executed through a strict vendor setup standard operating procedure. Under this protocol, the Director of Finance mandates that every new vendor must submit a specific portfolio of verification documents before they can be entered into the system. The first requirement is a formal credit application, which allows the finance team to assess the vendor's financial legitimacy and track their operational history. Next, the vendor must provide official tax identification records, such as a W-9 in the United States or its regional equivalent, ensuring full tax compliance. Finally, they must submit secure, verified banking details so that all payments can be processed as traceable electronic fund transfers. By forcing every supplier through the stock entry barrier, the hotel guarantees it only incurs liabilities with legally compliant corporate entities, eliminating the risk of paying phantom vendors. Once a vendor's documentation is verified, the relationship enters a direct financial negotiation phase. The Director of Finance is responsible for establishing standard payment terms tailored to each unique vendor. These terms dictate exactly when a bill is due after an invoice is issued, typically structured using industry standards like net 30 or net 45 days. This dual access timeline shows daily revenue collection on top and an outgoing payment shifting from 30 to 45 days on the bottom. This 15-day extension generates guest revenue before the supplier is paid. The AP system automatically schedules this optimal fund release. Structural adherence to these terms maximizes the hotel's liquid cash flow while systematically avoiding any risk of late payment penalties. With the vendor fully onboarded and terms set, the process shifts to the daily operational reality of invoice processing. The moment a vendor invoice arrives at the hotel, protocol demands a rigid first step. It must immediately receive a physical or digital date stamp. Following the stamp, the invoice must be logged directly into the AP system to establish a preliminary record of that liability. From there, an internal routing protocol securely forwards the digital record to the appropriate department head for operational approval. This calendar matrix shows an invoice arriving on the 31st of month A. The system forces that data point into the month A ledger, structurally preventing it from bleeding into month B. Allowing expenses to slide artificially depresses the subsequent month's profitability. This strict synchronization of dates and ledgers is known as accounting period integrity. Rapid date-stamped logging ensures the AP system constantly reflects a true, real-time picture of the hotel's mounting liabilities. Before a single electronic transfer is initiated, the AP system deploys a primary automated defense mechanism. The operational challenge is straightforward. We must structurally guarantee that the hotel only pays for exactly what it ordered and exactly what physically arrived. The solution is a tripartite control mechanism known as the three-way match integration. The system demands perfect alignment between three documents before they lock together. The purchase order represents authorized quantity and price. The receiving report details the physical count of goods received. Finally, the vendor invoice represents the supplier's ultimate financial demand. The AP system is configured to parallelize the payment batch until it confirms absolute numeric precision across all three documents, completely neutralizing the risk of overbilling. Even after the system completes its automated verification, human authorization remains a mandatory prerequisite before any funds are released. This requires a final gatekeeping structure, the payment authorization matrix. This pyramid illustrates an approval hierarchy based on monetary value. Department heads clear routine payments up to £1,000. The Director of Finance authorizes mid-range expenditures up to £5,000. At the apex, the General Manager approves major disbursements reaching £20,000. This hierarchy enforces a foundational auditing principle known as segregation of duties. By fragmenting approval power based on specific value thresholds, the matrix ensures that no single individual possesses the unilateral capability to drain the hotel's capital reserves. All of these daily controls culminate in the most critical phase of the financial cycle, the month-end close. A major accounting vulnerability emerges at month-end when a hotel has fully consumed goods or services, but the vendor has delayed sending the invoice. To capture these invisible floating liabilities, the AP system is utilized to manage the accrual process. Accruing means formally recording an estimated expense for those consumed items, ensuring the ledger accurately reflects the true cost of doing business that month. Processing these accruals through the AP system prevents the artificial inflation of the hotel's perceived monthly profitability. Like a massive structure relying on deep, immovable pillars, financial integrity requires an unyielding foundation. In a fully realized expenditure cycle, every dollar is preemptively authorized, verified against physical reality, and structurally captured in the ledger. This is a core internal controls philosophy taught at the Europe Hotel School London. A meticulously governed accounts payable system is the singular, non-negotiable requirement for producing a true and fair balance sheet.